Hi, I'm Peter Gelman of Palmerston Group Advisors. For those of you who've reached or expect to reach a financial success point where you can both live well for the rest of your life and transfer wealth to charity or future generations, figuring out how to do this as tax efficiently as possible is a big issue. If you're thinking about transferring wealth to the next generation, a key consideration concerns if and how to use life insurance as part of your planning. It's not a scintillating subject, but a few minutes about how to think about it may prove helpful. When it comes to life insurance, buyer beware is always a good idea. Life insurance products can be costly, especially permanent insurance products like whole life insurance and universal life insurance. And there are a lot of concepts involving insurance which, frankly, are a bad deal for everyone but the salesman. So be skeptical. In fact, be very skeptical. Always ask to be shown the bottom line benefit. Always do your due diligence. But don't be cynical. In fact, I'd say that maintaining that balance, skeptical but not cynical about life insurance, is the best posture to evaluate financial planning which involves life insurance. Generational wealth transfer is one of those areas where insurance may be a valuable tool. Here's why. First, insurance has certain tax advantages. Death benefits are income tax-free, and cash values inside a policy can appreciate tax-free and can be withdrawn during the lifetime tax-free, provided that rules are followed and the policy is not allowed to lapse. When insurance is inside of an irrevocable trust, it's usually outside of the estate and therefore usually free of estate taxes in addition to being income tax-free. And there also can be an inherent leverage advantage in a life insurance policy, which allows relatively small amounts of after-tax dollars paid up front as premiums in the early years to turn into relatively large amounts of tax-free dollars in the future. Those advantages may be offset by all kinds of costs and upfront restrictions, including surrender charges if the policy is canceled in the early years. So you want to see clear, significant advantages to utilizing life insurance before you commit. But if the circumstances are right, the advantages may be large. Second, governments are increasingly focused on taxing other assets that traditionally have been used to transfer wealth. These trends in tax policy may make insurance relatively more attractive than in the past. Speaking of taxation, the Secure Act, passed in 2019, eliminated the stretch IRA, inherited IRA, for almost all non-spouse beneficiaries. That change was a huge tax grab because it's an attempt to force inheritors to withdraw more money faster from those IRAs and pay more taxes, while many of those beneficiaries are at the height of their careers and their tax rates are at their peak because their earnings are at their peak. Where passing on a large IRA used to be a fairly straightforward method to transfer wealth, the new rules, with their higher tax implications, make it more attractive to consider alternatives, including insurance. So do your homework. Risks involving the estate tax also may tilt considerations towards using life insurance. As I'm making this video, federal estate tax exemptions are bigger than ever, but they are due to sunset, and many politicians favor significant reductions beyond that. Using insurance in a trust that's outside of the estate may help reduce the risk of future unfavorable changes to estate taxes. So for these and other reasons, make sure you investigate life insurance thoroughly. Be skeptical, be open, and weigh the pros and cons. Thanks for watching.